fact, I think according to the Bank of America recent surveys of fund managers and advisors, it's probably the advisors, we haven't seen this amount of cash on the sidelines since I think it was 2006, maybe even 2001. I do know also the same survey shows that the put to call ratio in the US market, meaning those short relative to those long put calls, is at 1.5 now, and it has not been that high since 2001. So we have an incredible amount of fear in the market, and that actually is the best time to average into these markets.
Hello and welcome to Crypto IQ. In today's video, the CEO of ARK Invest, Cathie Wood, shares her view on the current state of the market conditions and what innovations she thinks will be most disruptive in the future.
We know that we're getting a lot of deflationary signals, but the Fed isn't really buying into that yet. We think that the bond market, though, will start to convince the Fed. So the bond market is telegraphing either much lower than inflation, lower than expected inflation, or recession, or both. And we've seen the 10-year Treasury bond yield drop from 4.25 to 3. It got down to 3.45. It's around 3.6 right now. So that doesn't leave very much room. If you assume that the long bond is kind of a proxy for how fast nominal GDP will grow, it doesn't leave enough room for much growth and inflation. And we also know that the market always leads the Fed. And I think the bond market is speaking very loudly. Jeff Gundlach, very interestingly, Double Line's famous bond investor, very, very successful. He has made the point, okay, it does look like inflation's coming down. Why is it going to stop at 2%? And we would agree with that. We're seeing a lot of deflation in the pipeline. Commodity prices, discounts at retail during the holiday season to clean the shelves of massive inventories. So we think that's going to show through in terms of inflation. And very importantly, housing has taken it on the chin this year. Usually the Fed is very sensitive to that. Autos as well. They really went nowhere, and now used car pricing is down 14% on a year-over-year basis. So inflation will come down, and innovation actually is going to be part of that equation. The truly disruptive innovation platforms around which we have centered our research, so gene sequencing, robotics, energy storage, artificial intelligence, and especially artificial intelligence, as well as blockchain technology. All of them are deflationary in nature. Good deflation, it should cause a boom in the products and services associated with innovation. But deflation, another source of deflation. So our confidence there is building. We've been right on the inventory build, the commodity price decline. This period seems to be the flip side of the late 90s. The late 90s was an irrational increase in tech stocks, appreciation in tech stocks. And it was incorrect. The technologies were not ready. And even if they were close to being ready, the costs were way too high. So technology's not ready. We didn't get the cloud till 2006. We didn't get the big breakthrough in AI, deep learning, until 2012. The cost for DNA sequencing, $2.7 billion for one genome back in 2003. that number is down to $500 now. We are ready for prime time, and yet investors are doing the opposite of what they did during the late 90s. They are running away, running for the hills, running for their benchmarks, and we think that innovation is going to pose a problem for the benchmarks. So you bet we think innovation is going to work. We think it's going to work in a big way. We are ready for prime time for these 5 innovation platforms. Another question. Investors seem hesitant to invest now for long-term growth given supply chain disruptions and the economic downturn caused by rising interest rates. Why do we believe that now is a once-in-a-century investment opportunity? Well, a couple of reasons. Innovation solves problems. And we have a lot more problems now, even more than during COVID. We have corporations now experiencing margin pressure. And we have individuals, consumers, perhaps worrying about their jobs. And when we get into a period like this, businesses and consumers are willing to change the way they do things. And they embrace innovative solutions to their problems. Now, this once in a century is not an understatement. We have not seen more innovation platforms evolve at the same time ever. The closest is about 100 years ago, telephone, electricity, and automobile. Interestingly, back then, we were just getting over a pandemic, the Spanish flu, and over a war, World War I. And at the same time, we were experiencing incredible innovation. And so very similar dynamics. And what happened? Inflation peaked in June of 1920 at 24%. And within 1 year, it was minus 15%. We think we're going to experience a mini version of that during the next year. And then what happened? We launched into the roaring 20s when the stock market had, I believe it was a compound annual rate of returns of 25% for the next 8 years. The roaring 20s, we think we have a setup here for the roaring 20s, and it is all around innovation. So it is darkest before the dawn. And the best time to invest, according to Warren Buffett and the great investors of our time and of all time, is when there is so-called blood in the street. It's a crude saying, but it means when markets are deeply into bear territory. You should have, there's a cycle of fear and greed. And both are healthy. The fear should occur at the top of cycles, taking profits, and the so-called greed part of that dynamic should occur at the bottom of cycles. And surely after maybe an 80% reduction in, on average in our various strategies, we are closer to the bottom, certainly, than to the top, as we were in February 2021. Then we said, spare some powder. Now we would say, continue to average in with that powder.
Could Cathie Wood be right about the future of these technologies? Let us know what you think in the comments. Also, don't forget to like and subscribe. Thanks for watching, and we will see you in the next video.